Okay, so now let's go over problem 1721. I can see why several of you are having issues with it. The way it's explained in the book and the way it's shown in the book doesn't give you an overall view of what you're trying to do. So the first thing I did was go to page 869 in the book and create this table from the book right here. The one thing I added was this column for stockholders, the beginning and ending balance, so you can see how this all flows together. The numbers across the top are directly out of the problem on page 881. These are your beginning balances. So then we start doing the adjustments for the year. And the first thing we did was purchase or issue preferred stock, 250 at $164 with a par value of $100. So 250 times $100 comes up to $25,000 for the par value. The additional paid-in capital, 64 times 250 is $16,000. That gets popped right there. The next thing that they have, I believe, is common stock. And issued common stock, they issued 3,000 with a value of 17 per share and a par value of 10. So you've got 3,000 times 10 is 30,000. And then 3,000 times that 7 goes into the additional paid-in capital. The next thing they did was they reacquired some stock, and that means they took 3, and that stock cost, let me see what we got here, 200 shares at $15 a share, so that becomes a deduction. So that's 200 times 15. And that's $3,000. Next thing they did is they came down here and they reissued it. And what they did with reissuing was they sold it, reissued it at $17 a share. If you multiply that out, it comes to $3,500. No, if you multiply that, and they're using the FIFO. If you look on the end of this, it says the FIFO. So that means you have to go up and see what the first part in the retained earnings was $14 a share. So they reissued 215 times $14, which is $3,500, which goes right here. Now, you've got $14, and they got $17 for it, so that's a $3 difference. So if you take that $3 times that 250, that's $750. So where do you think that might go? That goes into additional paid-in capital. So you can see now we've got, before we didn't have any additional paid-in capital, and now we do because of this sale and because of the way they keep track of. And that FIFO means first in, first out. So they still had stock in at $14 a share. So that's how they issued it back out, using that as the par, theoretically, for the treasurer. And then finally, it tells we have a after-tax net income of $46,500, and then we have dividends that are going to be deducted from retained earnings. So now all we have to do is add this up. We started with $508,800, and if you add this across, you'll come up with $623,500. Now these two numbers are really important because you're going to average those. And that average comes up to $566,175. So how do I find the return on stockholders' equity? I take that net income of $46,500, divide it by the average stockholder equity for the year, which is $566,175, and come up with 8.2%. And I'm sure that's clear as mud. I think that the main thing that really gets us confused here is because we're doing treasury stock and we want to do something with the common stock. And you really can't do that until the year's end, and you'll see it just kind of balanced out here. So actually now I have 3,700 in treasury stock rather than 4,200. So I hope that helps a bit. Questions, please email me. Make a graph or a table just like this one and make sure you have all your numbers there. Thank you. Bye-bye.